Good morning from our global headquarters in New York. I'm Manus Cranny. Welcome to Bloomberg Brief. Let's set your agenda. Treasury steady after data shows the U.S. output is near stagnation, pushing 10-year yields to the lowest in over 2 weeks. Join the race. Intel hops on the latest run of AI product announcements, hoping to turn back the tide of losses. And Indian stocks head for the biggest intraday drop in more than 4 years as Prime Minister Modi's party inches towards a victory. A very good morning to you. These stock markets are heading for a summer of inconsistency. We're being dragged lower mainly by the oil markets. You're looking at the dollar index up by 1/8%. Intel rises by 1%. Pat Gelsinger gets on the stage and basically challenges Jensen Huang. 10-year yields, you're looking at a small moment of steadying the nerves. We dropped by 11 basis points yesterday. Manufacturing stagnated at a 3-month low. Now, bad news is bad news. That certainly seems to be the sense in this market. Clock Tower, Marco Papich over there talks about the disaster for the bond market if there is a Trump sweep, and that is a probability that they are raising. The dollar, we'll talk more about that with Daragh Maher. It's up by 1/8% despite the crushing blow in the short end of the curve yesterday, down by 6 basis points, not as much as the 10-year or indeed the 30-year part of the market. So we'll keep an eye on the short end of the curve. We're counting down to a little bit more data today. Well, it was after that weak data that reinforced the bets that the Fed will cut rates at least once this year. Yields hit the lowest in more than a week, as I said, and investors look forward to the JOLTS data later today. And the crescendo for data is, of course, Friday with the jobs report. Joining me now is Daragh Maher, head of HSBC Research for the Americas, and this is what he says. There would need to be a meaningful disappointment this week to see the Fed rate cut expectations pulled earlier and to discount a bigger magnitude thereof. The bar is high. Daragh, good morning.
Morning. How are you?
So, I'm good. Yesterday was a bit of a jolt. It was stagnation in the data. The yields dropped by 10 basis points. Further out the curve, I put it to you. But we've pulled forward the possibility of a rate cut to September. It's a 50-50 coin toss. Is the bar suddenly being challenged now in terms of the rates market and the thinking?
Yeah, look, I said the bar was high and the market jumped, so there you go. What can you do? I just find it all a bit weird. I mean, a couple of weeks ago, we were talking about US sticky inflation, economies are running hot. We have a couple of data prints out of the US and suddenly the economy is stagnating, rolling over, and we should panic and run for the hills.
You're sceptical, though, of that.
Well, I just don't think things move that quickly. I think the market is... What's the big picture in the US economy? Right. The big picture in the US economy, inflation is stickier, I think, than the Fed had anticipated. We've held again at 2.8% in core PCE deflator. The economy is slowing, but that's for the Fed. That's why you raise rates. That's why you have restrictive policy. So the danger is the market, of course, take a data point and extrapolate it all the way forward. And I think that's maybe what they've done yesterday with that data point.
What concerns me when I look at moves in the bond market, like I saw yesterday, at one stage yesterday afternoon I was doing prep for this, 30-year paper was down 11 basis points, the belly of the curve was down 9 basis points, but yet I looked at the dollar and the reaction function in the dollar was not as aggressive as it was in the rates market. Yeah. What is liquidity like?
It's reasonable. I would say there's not much conviction out there. People say, look, what are your clients saying about the dollar? And I think the answer is they're not saying a great deal, frankly. I got into a trade to sell euro dollar 3 weeks ago at 108.80. I think we're trading 108.80 this morning. It has been a yawn fest. And this is the challenge, particularly for currency investors, is what is the next big thing that gets us trending in this market? And it's been a struggle to find. For the bond market, last week, we were doing headlines about how awful everything was, these soft auctions, nobody wants to own US Treasuries. This morning we're running with headlines with everyone wants to own US Treasuries, and look at the massive drop in yields yesterday. Again, markets struggling for direction.
You start with the thesis that the dollar fatigue but maintains conditions for a sustained weakness are not there. So it's going to take an awful lot more for you to sell the dollar against the crosses.
Yeah, I think so. Look, this is a high-yielding currency. It's the world's preeminent risk-free currency. Yeah, the analogy we used was running the marathon, which, of course, I've never come close to doing. So
you're all right. I'm not there with you.
I had to point to my daughter. And you do hit the wall, and, you know, at some point, it doesn't mean you don't move forward. It just makes that momentum much harder to sustain. I think that's where the dollar is. I think the distinction you have to make is, do you think the dollar will strengthen further, or does it remain strong? And obviously there's a nuance there in the language. In other words, we think it holds on to its gains, but it's not going to knock it out of the park, as they say over here, in terms of additional strength, because it does face headwinds at these levels.
One of those headwinds, and Marco Papic over at Clock Tower wrote about this yesterday, was the risk. You've all got to now start strategizing for the risk for a Trump victory, a Trump sweep. And as he said, that would be, you know, fiscally, it would be a huge challenge here in the United States of America for the bond market. He evokes, you know, profligacy on the fiscal side. Are you beginning to model not just a Trump victory, but a GOP sweep? And what would that do, in your thinking, at HSBC to the dollar?
Yeah, look, I think currency market... So the short answer is yes, we are. The complicated answer is it's not clear actually what that would mean. Currency markets, you've been around them for a while, Manus, they love to oversimplify. They want to be able to say a Trump clean sweep equals dollar up, or, you know, there has to be that binary outcome. It's never going to be that simple. You know, yes, we have a fiscal angle. What about Fed independence? What would a Trump clean sweep mean for Fed independence? What does it mean for the geopolitical backdrop? What does it mean for trade policy?
But do you think that the market will begin, it will classically begin to take some option positions on to cover themselves? Maybe not outright flow in dollar, but you'll begin to see the various skews begin to heat up.
I think the simplest reflex is people will assume a Trump and a clean sweep for the Republican Party would be dollar bullish, for business friendly. Right. We're off to the races again on fiscal policy. But we also have to remember all those other counter-arguments. And I think, you know, for one, fiscal policy, what would actually a fiscal stimulus from this starting point in the US mean for the US dollar? Would it be a big yield story that supports it? Or would it be a structural story that undermines it? And again, that's why I think it's much more complicated than this Trump equals dollar up. I just don't think we're there.
OK, you want to make it more difficult for me. We've got a few things to pack away. Suzuki confirms intervention of $62.7 billion. I saw one lovely line. It's just too easy to be, you know, it's still easy to be short the yen. It is still the funding currency. Yeah. It's still a carry trade. With that amount of intervention, they're supposed to go limited and well-warned, according to Yellen, and be judicious in this. But it's becoming more often and in size. This is still throwing peanuts at the intervention gallery.
OK, so let me stand up for them, because...
You go right ahead. Go on.
Where would we be if they weren't? I mean, where would we be if they hadn't been talking intervention for the last X number of months, and if they hadn't actually deployed some cash to back it up? We could be at, I don't know, make up a number. So has it been effective? I would say yes, it has been effective. It's introduced two-way risk into a market that would have happily run away with itself. Do you turn it? No, but that might not be their measure of success. You know,
they could term a measure of success a cap.
Exactly. So to that extent, you know, they might be reasonably happy, but you are fighting this massive carry gap. It's narrowing, but it's still very generous. Everyone loves to get paid for doing nothing, and you get paid for holding dollar yen. So you're getting paid for doing nothing. I'll happily take that job.
You've got where are you? You're long euro dollar at 108. Where are we?
No, I'm short euro dollar.
You're short euro dollar at 108.76. So I suppose you've accepted that you're going to get your 25 basis point cut now. But what are you praying for? Consecutive cuts? Because the language around consecutive cuts is changing. Nagel, Schnabel, they're all sort of mounting the attack back against assuming that you're going to get multiple cuts.
Yeah. What I'm praying for is more stories like on Bloomberg this morning, offering exactly that narrative that we're not going to get consecutive cuts, because
you're trying to skew the spike. You
let's get into the meeting, yeah, where everyone's positioned the wrong way. Look, I think you've got 2 basis points or so priced in for a July move, so 1 in 10 chance, let's call it.
Yeah.
If you know, if we get anything from Lagarde that says July's live, I mean, not, let's say, a more probable than not, but in any way live as a meeting, the market has to reprice that, even if it's 5 basis points or 8 basis points, blah, blah, blah. So I think I'm pretty comfortable going to the ECB that side, particularly as you guys keep on telling me I'm wrong. So that just makes me happier.
We merely present two sides of the argument. To be fair, wages are hot. 4 big economies coming out of recession.
Well, these are lagging wages. You're getting wage growth based on what inflation was last year.
Darragh's here with the counterfactual and the argument. He's got counterfactual and he's got argument.
I'm talking my book.
It's all right. It's absolutely fine. We'll let you do that. At least you're honest and you're declaring your position. Daragh, good to see you this morning, setting the tone. Daragh Maher of HSBC, my guest on the markets. Other stories trending on your Bloomberg terminal this morning. What have we got for you? Airbus is in talks to sell more than 100 wide-body jets to China. The talks have gained momentum since President Xi Jinping visited France and met his French counterpart, Emmanuel Macron. That was last month. The terms are still being discussed, and the timing of the deal is somewhat uncertain. Maersk has raised its full-year profit forecast. The shipping giant says the congestion in the Red Sea is having a larger than previously expected impact on the world's supply lines, which in turn are boosting freight rates. Skydance plans to offer $23 a share to investors in Paramount's voting stock. Now, this is said to be part of the plan to merge with the firm and the TV giant. The bid would be made to investors other than members of the Redstone family, which holds most of that voting stock. Coming up, Intel's Gelsinger fires back at NVIDIA's Huang in the battle for AI chip leadership. More on the story. That's next. And we speak to Henrietta Pacquement of Allspring Global Investors on why U.S. growth exceptionalism is starting to show cracks in the armor. Context matters on Bloomberg.
Look now to have 1 billion transistors on a single chip, and even looking to 1 trillion transistors in a single package by the end of the decade. And unlike what Jensen might have you believe, Moore's Law is alive and well.
The Intel CEO, Pat Gelsinger, they're firing back at NVIDIA's Jensen Huang as the chip giants unveil the new processors amid a heated AI chip race. For more, Matt Bloxham joins me from Bloomberg Intelligence. It was like the rock stars of the chip world sort of fighting it out. Gelsinger has a lot more to convince the world of, doesn't he? His stock is down 39%. His chip business is not exactly firing on all cylinders. What do you make of the bravado? Good morning.
Yeah, hi there. So the key message from them is this faster, cheaper, and more accessible with this new Gaudi chips. You know, we're very familiar now with the Hopper, which is the NVIDIA AI chip, and Intel comes in with the Gaudi 2 and 3. You know, it's really interesting that they're talking about these kind of big performance advantages over equivalent NVIDIA chips and being substantially cheaper, as much as 1/3 of the cost of an equivalent NVIDIA setup. So I think they're making a really big push. And I think the interesting dynamic here is that so far, a huge amount of demand for these AI chips has been from the so-called hyperscalers, so the Googles, the Microsofts, well, the big kind of cloud platform providers. But the expectation, and NVIDIA's been talking to this too, is that the future demand is going to come more from the enterprise market. Now, historically, that's clearly where Intel has had a much stronger position, so that timing-wise, it makes sense that they're coming out with this now. And the pitch is very much to those enterprise clients that are looking for a combination of performance and return on investment. And obviously, a lot of those enterprises are already using Intel-based server architecture, so there is definitely an opportunity for them there. But it's going to be a difficult slog, I think, to kind of really convince a huge amount of customers to kind of shift allegiance, if you like, from the NVIDIA platform. But that they have to be in there. They don't really have any choice other than to try to grab a share of this really important market for the future of technology.
Well, maybe that will ultimately come down to pricing. Look at the margins that NVIDIA has relative to the pricing in the market. Ultimately, price and delivery will be sort of traded off. We've seen it time and time again, a commoditization of a high-value, high-premium product, especially in the tech space. Let's pivot to Apple. I mean, we're back in the black for Apple for this year. So, again, all the skepticism around Apple seems to be incrementally being undone. What is it that shifted the narrative for Apple?
Do you know, I think part of it earlier this year, there was a lot of clouds over how they were performing in China, which is kind of 15 to 20% of their sales. Actually, they surprised the market in how resilient that was being. I think then the news has been more positive. Obviously, they gave us a teaser a few weeks back about what they're doing on their own AI strategy. And I think people are looking forward to this big event in the next week or two, the Worldwide Developer Conference, which is where they'll really lay out in more detail the substance of their AI strategy. And, we're kind of seeing a shift, and we heard it again yesterday with Intel about this, the importance of the AI PC. I think we're going to see that AI smartphone become really important too, and obviously with the launch of the next generation iPhone coming up probably in September, I think this big event in the next week or two that Apple's hosting will give us some signposts of that. I think it maybe is an opportunity for Apple to kind of reignite some excitement about creating or evolving that core product category for them and kickstarting revenue growth again for them in that space, which is iPhones are over 50% of the revenue. So it's really important for the kind of outlook for Apple to kind of give a good sense that that's a growing category.
Okay. And certainly, if you look at what Wedbush are saying, it's this next movement, the iPhone 16 super cycle, and how that is going to be monetized from the AI perspective. Matt, thank you so much for joining us on the Tech Stories this morning. Bloomberg Intelligence, keeping it real. From Silicon Valley to Wall Street. So we had a glitch during a software update early yesterday. That led the New York Stock Exchange to erroneously halt trading on about 40 stocks, even displaying trades showing 99% drop in some companies, including Warren Buffett's Berkshire Hathaway. Let's talk to Charlie Wells about the glitch and the case for reverting back to the old software, or is everything fine? Innovation costs, doesn't it, Charlie? What do the NYSE have to say?
Yeah, look, so they said that this was related to a glitch tied to software that controls limit up, limit down halts. Now, that is a little bit ironic because those limit up, limit down halts are supposed to protect investors in the event of volatility. That's not what we saw yesterday morning when we saw a lot of volatility in the New York Stock Exchange. I think something that really stuck out from yesterday was Class A shares of Berkshire Hathaway being offered, it looked like, for a 99% discount. Now, the New York Stock Exchange has said that it has resolved those issues. It resolved those early in the day yesterday, and those trades that were made based on that odd pricing are going to be canceled. But this is an issue, and putting this into context, a lot of people have really been holding their breath since that transition to T+1 settlement, right? That is speeding up trading, and I think there had been a lot of concern about what could happen. Yesterday, there were questions about whether this glitch was tied to that. It seemed like it was just bad timing, but of course, it's been bad timing for the past week, where there have been 3 incidents in U.S. markets that have interrupted trading in this manner.
Could you imagine the anaphylactic shock you'd have if you had Berkshire Hathaway and you opened up your portfolio reval 0? I mean, that's pretty nightmarish. Listen, and good to hear all those trades have been busted, all the stop losses that would have been triggered. I can remember well when that happens. Talk to me about how you choose to have as your client. We understand from the Wall Street Journal that GameStop evangelist Keith Gill is reportedly at risk of being kicked off E-Trade. Now, this is the electronic trading platform. Is Roaring Kitty having his claws clipped?
Great question. I think if you're going to try to clip a cat's claws, you've got to be ready for some of the risk as well. And look, this gets to the issue of market manipulation and meme stocks. So we saw yesterday a rally in GameStop, and that was on the back of a Reddit post by Keith Gill. He returned to the Reddit platform for the first time in a long time yesterday. But this calls to mind what happened in May when Gill posted on X a post that sent the shares surging. But of course, he uses the E-Trade platform, and people familiar with the matter told the Wall Street Journal that they saw Gill make large options purchases before that tweet, and some of those options expired that very week. And so there are questions about whether this was market manipulation. We know the SEC is looking into this regarding GameStop, but I was talking about a potential backlash, and that potential backlash is that army of Gill supporters leaving E-Trade potentially if Gill is kicked off.
Okay, Charlie, thank you so much. That is Charlie Wells on the very latest with GameStop and Keith Gill. Some breaking news for you from the Bank of Japan. We've just been talking to Daragh Maher about the Bank of Japan's action in the currency markets. This is in the bond markets. It's said to be mulling reducing its bond buys as early as the June meeting. They're going to watch markets till the very last moment before they decide. Is said to have no intention to surprise bond traders. So again, this is about adjusting both in terms of intervention in the FX side and in terms of their participation in the bond market. Now, there is dollar yen 155.16. We just had that conversation with Daragh. We had the confirmation by Suzuki that there had been intervention in the dollar yen market of over $62 billion. And the counterfactual is, of course, as Daragh said to me, well, if they hadn't intervened, where would dollar yen be now? More to come on Bloomberg. Good morning. Indian assets under pressure this morning as Narendra Modi BJP party looks as if it may not get the 272 seats it needs on its own, but may well have to do an alliance. You're looking at the Nifty, the biggest one-day drop in 4 years, and of course the dollar bid against the rupee. Volatility's up. From our global headquarters in New York, I'm Henrietta. Let's set your agenda. Treasury steady after data shows the U.S. output nearing stagnation, pushing 10-year yields to the lowest in over 2 weeks. Join the race. Intel hops on the latest run of AI product announcements, hoping to turn back the tide of losses. And Indian stocks head for their biggest intraday drop in over 4 years, as Prime Minister Modi's party inches towards a win. So bad news is bad news. That's certainly the conclusion by the market. We are grappling with a stagnation, or that's the tone from the PMIs yesterday. But do bear in mind, you have had the third best run from January through to the end of May since the year 2000. You're going to go into a summer of inconsistency, according to JP Morgan. Stocks are lower this morning. We saw oils taken down in the European session. Look at that oil market. Brent getting crushed for a fifth day in a row. We lost 3% in value yesterday. The Bears are very firmly in charge. By the way, Joe Biden will be refilling the SPR with 3 million barrels today. So this drop in price in oil is certainly a boon for the Biden administration. 10-year government bonds are flat at the moment, 439. Do bear in mind, we dropped by 11 basis points yesterday. Manufacturing now, the narrative is around stagnation nation in the United States of America. It's amazing how quickly we vault, obviously, from sticky inflation and soft landing to perhaps something a little bit more challenging. Clock Tower had a big piece out yesterday talking about a disaster for the bond market if there was a Trump victory and a sweep. Fiscal profligacy is what Moko Papich is talking about yesterday, and that's certainly permeating through the minds of the bond traders. Well, treasuries remain steady. Investors are weighing their concern about the health, the robustness of this economy, and stronger expectations for an earlier Fed policy move. September is now 50-50 in the minds of the swaps traders. Let's get to our Bloomberg macro strategist, Simon White. How quickly the narrative changes. That's what Daragh Maher was just saying to me there 10 minutes ago. Last week, we were talking about really sticky, enduring inflation, higher for longer. One print on the ISM and this bond market really did convulse yesterday. Are we going to now hear narratives around stagflation? Good morning, Simon.
Good morning. Yeah, I think it's a bit of an inflection point. I think we've went from a period where, essentially you had low recession probability, and it would take quite a lot to shift the dial to suddenly it becoming a much higher recession probability. But now, it's like an S-curve, if you like. So we're now at the point where the gradient is potentially going to become steeper, and therefore it wouldn't take much to in terms of the data, to suddenly you're in a situation where recession has gone from like a 2 or 3% probability to maybe like a 70 or 80% probability. And that means it's a lot for the market to digest. So where yields are right now, they're trying to kind of factor in that potential change in recession likelihood.
I mean, if we go from the narrative of soft landing, no landing, to something much more aggressive, what does that do to the bond market? Because this bond market has been hovering around the 4.5s for quite some time, and this could be the catapult that it needs I suppose, to emboss the HSBC narrative of lower yield?
Yeah, I mean, I've looked at a lot of the positioning metrics, so you can infer positioning where hedge funds are positioned, where CTAs are maybe positioned, and I think positioning has become a lot more neutral. So therefore, people are ready to, maybe take the next trend. So I think 4.5% has been a bit of an anchor point. You can try and sort of ascertain what you think is quote-unquote fair value for bonds based on things like the Fed rate and the yield curve. And 4.5% is roughly there or thereabouts, which means that we're looking for the next kind of push, which direction it's going to be, with positions being much clearer as they are. So if we're going into this period where, the data is going to start to weaken, and as I say, you've got recession risk rising, which doesn't mean a recession is definitely going to happen. It just means people are going to have to be thinking about it a lot more. And if that's the case, then yields are going to want to reflect that, because you're going to have the possibility that more likely that the Fed will be looking at cutting rates again. So I would say for the interim period, probably over the next few months, you're looking at lower yields. But I think the broader picture is still there's an inflation problem.
Yes.
And so I think the bigger picture is inflation will start to rear its head again, and yields will reflect that. And that might be a later in the year story.
OK, Simon, thank you very much. That is Simon White. We're counting down to the JOLTS data today, along with the services data, the ISM services data, all the way through to the jobs report. Don't forget jobless claims on Thursday, and non-farm payrolls, 185,000 is the survey consensus. My guest this morning, to make sense of it, better sense than I will, is Henrietta Pacquement, head of global fixed income at Allspring. Henrietta, great to see you. Listening to Simon there, it's amazing, and to HSBC a little bit earlier, how quickly we flip-flop from sticky, higher for longer inflation last week. Today, we're talking about a 50-50 coin toss that September is live. How quickly can this bond market begin to move towards a harder landing narrative?
Well, it's really interesting because last time I was on the show, we talked about some of the US data really taking a little bit of a turn for the worst. So I think what we've seen over the last few days is a bit more of that. So not necessarily a surprise, and explains why we do like the bond market at this point. And we still think that we're in this situation where the inflation aspect and the growth aspect are going to fight it out over the next few months. So it makes sense to sort of see that volatility at this point.
And it's healthy volatility for anybody that's trading bonds out there. A bit unnerving for you if you've jumped in and gone long duration and went, hurrah, 4.5%. Actually, you're making money. You're trading at 4.39 at the moment. So maybe duration hunters that jumped in are doing quite nicely. Here's the thing, though. Do you think stagflation is a narrative that will rise again? I mean, we go through these narratives, don't we? Soft landing, no landing. I just get the sense now that we're probably going to start talking more about stagflation if we get a softer JOLTS and if we get something irksome on Friday in the jobs report.
Yes, we're looking for a theme at the moment. Inflation is still proving to be a little sticky. Mm-hmm. I mean, there are three aspects that we look at for the inflation story. It's the level, it's the breadth, and it's the stickiness. So I think level is still arguably a little high. Breadth is looking better from our perspective, and there is still a bit of stickiness around. So the inflation story has not gone away. So that explains the talk of stagflation. I think what's a little different is the growth story, particularly on the US. So yes, at this point, we're looking at the sort of growth numbers, and we're keeping check on the inflation side to make sure that we still get a tick down, or at least not a worsening of that aspect.
So we spent quite a bit of time talking about the yield differential between the States and Europe, and now we're going to talk about a growth differential between the US and Europe, which of course makes the ECB's job all the more challenging. I look at CPI 2.6%, wages 4.7%. I'm curious to get your view, because everybody's batting away the wages and batting away the fact that four of the top economies in Europe have averted, they've come out of recession or averted recession. How much harder does that make to the cadence of rate cuts that is assumed by the market and probably priced in at the moment for the ECB?
So obviously we're going to get a cut this week. That's very much expected. The question is what comes next. Yes, we've seen a bit of a repricing there. At this point, we probably think that July is out in terms of a further rate cut. So the ECB is going to cut and then have a look and see how the data pans out. Growth is better, and we've seen some green shoots there, but it's not extraordinary. So I don't think that necessarily is something that's an issue there. Yes, the question mark remains on inflation, and a bit like the US, not at the same level, obviously. We need to keep an eye on that, and wages are a component of that. From our perspective, the sort of pressures in Europe at this point are less than in the US, which explains more cuts in Europe that are priced in at this point compared to the US.
What does that do for credit? I'm looking at your credit perspective at the moment. Lower credit quality has had a better performance given the levels that we've reached. We tread carefully in the lower credit spectrum. I just wonder, is that the same for Europe as it is for the US? If I'm getting better and more robust growth numbers from Europe and possibly a sequence of cuts in Europe, does that begin to underpin credit in Europe relative to the US trade?
Well, it has already. I think we've seen the credit markets really price in a benign environment from a growth perspective in the US and more lightly rate cuts in Europe. So slightly different drivers there. But we have got an environment across the spectrum which is pricing in a not a bad environment for credit at this point.
So I'm sort of quite drawn by this clock tower piece that was written yesterday. It's by Marco Papich. Talks about the probability of a Trump victory. That's, it's hard to call, but they say a Trump victory upgraded to 60%. But I'm drawn to the language that Marco uses. Bonds will start pricing in a higher level of fiscal profligacy. They see a Trump victory as an epic disaster for bonds. Now, of course, he reflects back to 2016. I know bond prices are at a different level to where we were in 2016. I know the reaction function may well be different to 2016. People are throwing tomatoes at the screen right now at me. But, I mean, this is quite rich language, and that's what I'm drawn to it. Do you have a concern that the bond markets will have a touch of anaphylactic shock on a Trump victory?
Well, it's a really interesting one. I would say that the US has been pretty generous from a fiscal perspective already. And I think our stance is, whether you get Biden or whether you get Trump, yes, you are going to be in this sort of looser fiscal environment that we're currently seeing in the US, and partly explains the sort of US growth exceptionalism that we had earlier in the year and in 2023. So for us, it's more of a continuation of what we're seeing now. Probably how it's going to affect the markets is going to be different. Biden has been more on the sort of spending side. On the Trump side, it may be more related to the tax element. So yes, our stance is that we're going to have a generous US from a fiscal perspective going forwards.
Well, let's hope that the bond markets don't mind hope they can bank on the generosity of strangers. Well, we know who most of them are, but I think you know what I mean. Henrietta, great to see you this morning. Let's count down to that ECB and the tonality and the intonation from Madame Lagarde. Henrietta Pacquement at Allspring. Her calls on the markets. Coming up, not so nifty. Indian stocks tumble as the early vote count points to narrower than expected win for Narendra Modi. You're looking at the Nifty there, one of the worst days on the Nifty in over 4 years. Volatility is spiking by 42%. It looks like Modi is going to struggle to get this absolute majority for his own party without working in tandem with his allies. We're live to Delhi for the latest. Context Matters on Bloomberg. Bloomberg Brief. I'm Henrietta in New York. A very good morning to you. India's stock market is set for the biggest drop since March 2020. We've got a tight election battle. Prime Minister Modi. Let's get a little bit more from our Bloomberg reporter, Ruchi Bhatia, joining me now from New Delhi. Ruchi, the markets are literally convulsing. Stocks, bonds, really taking it badly. That this super majority that they presumed that Modi would get simply is not coming to pass. I mean, just update us. I mean, we're looking at convulsion in the equity market. What is the major consequence if he doesn't get the supermajority as presumed?
Well, as we speak, Manas, the Indian markets have stabilized a bit. But having said that, the stocks are still having their worst days since the COVID pandemic in 2020. The expectation was that Prime Minister Narendra Modi will come with a supermajority, and that would mean that he will have the mandate to push through some of the critical reforms, some of the hard structural reforms like land, labor, farm sector, etc. But looks like domestic compulsions are going to, take much of his time, because he and his ruling Bharatiya Janata Party have not been able to cobble up the majority mark of 272 out of the 543 seats. We're way past the halfway mark in terms of the counting. Nearly half the votes have already been counted, but the Bharatiya Janata Party is still short of the majority by itself, which means that the opposition parties will be pretty strong. He will need his allies to push through some of the critical reforms, which will mean some sort of a delay in decision making as well.
Yeah, look, we're seeing this reflected in those close companies to Modi, the Adani family companies, Adani Ports, Adani Industries, all really taking this hit in terms of the political allegiance. But from where we sit in New York, obviously, there's a huge exposure for companies like Apple, the FDI story, the onshoring story in India. How might this political nuance impact American corporates?
So you're right. The Adani company stocks have lost almost about $40 billion in market value today. However, on the other side, we are seeing some of the consumption stocks doing well. Having said that, as far as the broader policies are concerned, because it does look like the ruling Bharatiya Janata Party and with allies will be able to form the government. As far as the broad macroeconomic policies are concerned, they will still remain on track. A lot of good things have been built into the system. For example, the kind of spending that we've seen on infrastructure. But as far as crucial reforms are concerned, like land, labor, farm sector, etc., the government will find it hard to push through these reforms, because these reforms are critical for them to be able to get the supply chains to India, to get the manufacturing firms to come and set up their base in India. India is already in talks with the likes of Tesla, for example. And, how the existing dispensation, the new government will be able to woo companies like China, one will have to wait and watch out for. Also, I must also mention that India was also seen as a counterbalance to China of sorts. So how will those policies play out, and whether India will continue to remain as assertive on the global stage or not is something that we will have to watch out for. India wants a seat at the table. Whether it will be as assertive as it was in the past is something that we will have to wait and watch out for.
Ruchi, certainly there is a tough time in the equity market this morning. We're just showing a whole cast of losses there across the equity market. Ruchi, thank you so much for being with us. Ruchi Bhatia. A glitch. There was a glitch in the software. There was an update on Monday in the New York Stock Exchange, and it erroneously halted the trade on about 40 stocks. Here for a little bit more context, Charlie Wells joins me. Look, Charlie, there's going to be lots of people screaming from the rooftops going, go back to the old software. They have this update. We've got one-day settlement. What has NYSE actually said?
They have said that this was a glitch that was tied to some limit up, limit down processes. But look, I think there's going to be a lot of fingers pointed, but some of the more dovish analysts that we talked to yesterday indicated that, look, maybe we're spoiled. Maybe we're used to a lot of uptime, and as you upgrade this technology, there's going to be some kinks.
Yeah, and I mean, when you open your portfolio and you see that Berkshire Hathaway is down 99%, you just got to hope that your broker didn't have a stop loss in there, and the undoing of all of that carnage. Talk to me about Keith Gill. I mean, he's the evangelist of GameStop. Now, we got reports that he maybe kicked off E-Trade. What do they not like about him? Do they think that he's maybe having his roaring kitty, possibly having his claws clipped?
So people familiar with the matter told the Wall Street Journal in a report that employees have been looking at some of the large options that Keith Gill bought on E-Trade before the tweet he sent last month that sparked that rally that we're talking about, very similar to the rally that is happening this month. We know the SEC is also looking into GameStop options and market manipulation. The risk, though, is if you kick someone that popular with the Reddit crowd off of your platform, many others could follow.
Yeah, and the flow that goes with those meme stock traders is considerable. Careful what you do to your brokerage flows. Charlie, thank you very much. Charlie Wells at tracking the stories. I want to give you a snapshot. We just spent some time on India. Narendra Modi under pressure in terms of acceding to the majority that he needs. What have you got? Nifty is the biggest drop in 4 years going on there. You've got the dollar bid against the rupee. It's the biggest move up in the dollar, down in the rupee in 10 months. Volatility is toxic there today. Volatility ratcheting by 42%. And Adani Enterprises, as you can see, down some 20% at the moment. Let's see how that impacts the rich go narrative for Gautam Adani. Coming up, Secretary Yellen testifies on the first debate in the UK election. We have a lot to keep our eyes on today. Good morning from New York, from Bloomberg, where context matters. Bloomberg Brief, I'm Henrietta in New York. Let's check in on what's going to be the focus of your day. The JOLTS, the job openings, factory and durable goods orders at 10 a.m. Eastern. We're going to listen to Janet Yellen, the Treasury Secretary, testifying before Senate subcommittee. That's at 2:30 in the afternoon. Rishi Sunak and Keir Starmer in the UK, they face off in their debate before the election. That is at 4 p.m. Whose policies, at the moment it looks on those polls, a potential supermajority for Keir Starmer, if the polls are to be believed, against Rishi Sunak. Some individual movers for you. Pat Gelsinger got on the stage and evangelized about the propensity for AI. It's the only bid-up chip maker on the market this morning. To see Gelsinger unveiling a new processor in the battle for AI supremacy. Stellantis, the EV battery venture led by Stellantis and Mercedes, pauses the development of a factory in Germany due to poor demand. GitLab, application software, the company's revenue forecast came in weaker than expected. We're down nearly 4%. I want to leave you with a snapshot of what's going on in currencies. The yen is moving. This is the euro down and the yen higher quite considerably as we see a potential shift in quantitative tightening from the Bank of Japan. It's the second day of gains, and Suzuki confirmed intervention.